For the ultra high net worth, though, the people that have 50 million or more, they invest 81% of their dollars into alternative assets.
When it comes to angel investing or venture capital, you're kind of there at startups, different words for it. You're going into a startup scenario or a venture that's they're just bootstrapping. You have to like the idea, but love the person.
Welcome, everyone, to the Directed IRA podcast with Matt Sorensen and Mark Kohler. We are here talking about alternative assets in 2023, baby.
Oh, whoa. I thought we were talking about alternative lifestyles. Did I got the wrong memo?
No, it's not alternative music either. Alternative lifestyles. Jeez.
Man,
What podcast do you think you're on?
I don't know. This is a big topic right now. I'm like, oh, okay. So we're alternative assets. Okay.
Alternative assets. It's not talking about alternative music. This is not your CD collection of Pearl Jam and Stone Temple Pilots and Nirvana, although that could be an asset and very valuable. That's not what we're talking about.
Now, see, Matt went there. I would have gone The Cure, Thompson Twins, and U2. But see, that's 80s. You went 90s on me. So
I did. You know, I'm a 90s guy. So at the end of the day. All right. Well, we're talking about alternative assets. Well, what is alternative assets? Guys, it's pretty much everything besides the stock market. Alternative assets are what most of our clients are investing in our law firm at Directed IRA. They're entrepreneurial business owners. They don't just want a stock or an ETF. Sure, we can have some of that, but we want to be investing our money in these other quote unquote alternative. That's the label they've been giving. But what we're talking about is really two categories here: real estate and private business. All the alternative asset investments you can make really focus around private businesses, small businesses, and real estate. Whether it's a rental property in real estate, lending money on real estate, investing in a fund that's buying a multifamily or commercial property in real estate, whether it's investing in a small business down the street, a startup that could be the next Uber, whatever it is, a private equity firm that's growing businesses, like these are real estate or private business investments. They've just got the label alternative.
And I want to be transparent here too. I get a little credit, not from my kids, but from a lot of followers that are like, Mark, you know that. You're so smart. You're all this. And I appreciate that. I've been able to create this really a persona that I'm smarter than I really am. But no, when I literally, and I know this sounds, but I'm being transparent. I didn't even understand or know the word alt assets until a year ago at best. It's just if some of you are like, oh, you guys have coined this phrase. No, it's been around. And what's funny is, I mean, I know what alternative assets are, but I didn't know about this term. And come to find out, and this has really been kind of a discovery. Matt has known about it much more than I, but in the world of people that are building wealth, this is a term they use a lot. Mm-hmm. And if you want to build wealth, knowing this term is critical. And I didn't know that. This has been kind of news to me, this alt asset world. Tell them some of the quotes. I love your 8% quote.
Yeah, I'll hit that one right out of the gate. Okay, let's talk about, this is a survey done by Ernst & Young, big public accounting firm, looking at people based on their level of wealth, how much percent of their investment portfolio is in alternative assets versus the stock market, okay? This is alternative assets versus stock market. What they term the mass affluent, those people with 100,000 to $1 million and invest. 14% of them invest in alternative assets, or 14% of their portfolios are invested in alternative assets. The other 86% is basically in the stock market, mutual funds and ETFs. For the ultra high net worth, though, the people that have 50 million or more, they invest 81% of their dollars into alternative assets. That means they're only leaving 19% left to the stock market. Now, a lot of people look at that and say, well, the more money you make, the more money you should put in alternative assets.
Or the more opportunities you have.
That's true. Or you could look at it the other way and say, how about the more money you invest in alternative assets, the more wealth you get?
Yeah.
You know, that statistic goes both ways.
Yeah, it does. And I was just throwing out some of the perceptions people have. Well, you got to have money to make money, or I can't really do all assets till I have more money. How about you start doing all assets so you have more money, and there are opportunities to invest in all assets. It's again, this is why I wrote a book called What Wall Street Doesn't Want to Tell You. This is true. They
Yeah.
don't. When you do all assets, Wall Street does not make money. And what is the biggest lobby, the biggest machine in America? It is the banks and broker dealers
Yeah.
and Wall Street. That's it. So why don't
Yeah.
so don't blame yourself if you haven't learned this. So we're trying to expose this. There's probably targets on our back. We may not be here next week. Who knows? So
Yeah. Yeah. If we get taken out, I just, suspect number one is going to be Wall Street. All right. That's the usual suspects, they line them up: Citibank,
yeah.
Bank of America, Morgan Stanley, JP Morgan. Anyways. Okay. Here's an interesting one. Speaking of Wall Street, JP Morgan did a report themselves. This is Wall Street themselves, saying that the typical 60-40 portfolio that the typical financial advisor would recommend, which is 60% of your investment should be in stocks, 40% in bonds, said if you actually change that to 30% in alternatives, 40% in stocks, and 30% in bonds or fixed income, your returns go up and the volatility of your money going up and down decreases. This is JP Morgan. This is Wall Street themselves coming out and saying people need to be investing in more alts. Now, of course, what they're doing is they're saying, and we have alternative assets now that we want to help you with, because they've realized, look, our clients are getting the short end of the stick. We got to deliver more yield, more returns for them. Our clients are demanding it. We need to start including alts into these investment portfolios. And so they are finally getting smart to it because the numbers don't lie. They know they can get better returns for their clients. And so this is where where we've been already, but we want to make sure everybody knows you don't have to be stuck in Wall Street with your IRA or 401k. You can self-direct it. That's what we're doing every day at Directed IRA. All these alternative assets we're going to talk about, we've already mentioned, from real estate to private companies, all these things you can own in an IRA. You just can't do it with a Wall Street IRA. You need an account at Directed IRA.
Yeah. And today's show, that was the introduction. So we're going to get into some real meat. But what we were hoping to do is light a fire, open your eyes, pull back the curtain, define some terms, because now we want to throw down. Last week we did a 2-day event, the first alt asset summit we've ever heard of. And we held it in Costa Mesa, California. It's sold out. You can still get the recordings if you want to go to altassetsummit.com. We had 15 different presenters, approximately 10, 15 vendors, and we had a wait list of people that wanted to get on stage and talk about their alt asset approach. We gave a big disclaimer. We weren't saying to buy these people's investments, but we said, here's some options. And we finally put our big boy underwear on and said, we're just going to start showing people what's out there. Because a lot of lawyers and accountants, they're afraid to do that. They're afraid to tell their clients, oh, you should go invest in this kind of stuff. We're not an investment advisor telling you what to buy. We're a financial advisor telling you you should be buying in this class. Now get out and do your homework. Here's some options. And it was a huge success. People loved it. Matt did a great takeaway on all the points he felt were the real big takeaways from the event in his LinkedIn profile. I thought it was fantastic. So I'm going to be color commentary, Matt, as you give us your top takeaways and what some of these big alternative asset opportunities were. And that people get a pen and paper handy. You want to take notes.
Love it. Let's hit the first one, multifamily real estate. This has been a hot topic. Everybody's been interested in multifamily. There'd been a shortage of it, right? There was a lot of increased demand in it. People think with housing affordability and the cost of buying a home going up so much, people are going to need to be more in multifamily as population grows and people can't afford a home anymore. Unfortunately, this is just the trends we're going to see. So multifamily has been a hot asset, and we've seen a lot of people investing in it from their IRAs here at Directed IRA. That is one of the most common investments someone will make, but they're investing into a fund or a syndication. They're investing with 100 other people that they're pooling their money together, buying a 100-unit apartment complex. And we had Vina Jetty speaking, who's reaching $1 billion in multifamily assets, the funds that she manages. She buys, the current one she's buying is a 400-unit project in Arizona, actually, over $100 million itself just in that deal. And so very experienced operator in this type of space. She gave a really good presentation on what to ask a multifamily sponsor. When you're looking at someone who says, I'm buying multifamily and you should invest with me, what should you look for? And she gave one really good quote that I wanted to share. She said, when vetting an investment sponsor, the person syndicating or running the fund, Ask them about a failure or problem they've had on an investment asset. And if they don't have one, they're either not being transparent with you or they don't have enough experience to be investing your money with them.
Mm.
And so ask for those. Now, I actually asked her, funny enough, because I got her back on a panel, that question, because she's raising money. What was yours? You know? And she talked about a property where lightning literally struck and all the things they had to do and how it did cause some problems and disruptions, and they weren't able to hit the returns that they were hoping to make on the project. But I think as you're vetting someone as an investment sponsor, someone you're investing your money with, you got to be asking these questions. Mark and I did a top 10 due diligence list at the summit, going over the 10 things you should be doing when you're investing your money, the due diligence items that you should be doing. So as you're investing in alternative assets, what you're going to see it, and Mark and I have joked about this, is it's like you're not like at the grocery store just picking up something on the shelf and checking out. That's kind of like buying a stock or an ETF in your Robinhood account or your Schwab account. This is more like going to the swamp meet, you know, or the farmer's market. And you're like negotiating. There could be some weird stuff over there, but there could be a great deal too.
There's some bargains.
Markets, yeah.
Well, I want to echo some of your thing that you said. I was in Maui at the Better Life Conference, kind of a spinoff of a variety of those. Yeah, yeah, and they were just Brandon Turner helped sponsor that Bigger Pockets spinoff, and it was just great. And one of the presenters, Kathy Fetke, I want to give her a shout out because Kathy went through. She didn't get up and go, here's all the projects we're doing and here's what we're going to make. Her presentation was, here's the projects we did and had problems. That was her whole presentation. And it was so cool to see her go through and go, yep, we underestimated the turnaround time on permits and construction. Oh, we didn't expect COVID and da 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 da. But you really started to understand she knew what the hell she was doing and what they're doing in their multi-unit fund. And they also have a single family home fund, and they're doing different things. But I just want to echo what Matt said. When you're looking at syndicators that are doing because I can't go out and buy my own apartment building. I can't. I mean, I don't have the skill set and I don't have 100 million laying around. But these syndicators are like, hey, we can do that and get you double digit returns or better and be the point person for you. So back to my original point, some of you go, well, it takes money to make money. That's the beauty of these new equity funds and the syndications is you're getting to play in these bigger projects with people
Yeah.
that know what they're doing. And so
Yeah.
that's point number one. Love it. Multifamily. Well, number two, what do you got? Number two. Let's work it.
Yeah. Well, here's another one in investing in someone else's funds or deals is make sure you understand their strategy, right? And so when you're out there looking, two great speakers we had on this, Chris Loeffler from Caliber, big asset manager doing large real estate deals. He talked about how their niche is in the middle market. And when you looked at the opportunities out there and where they can make money, they realized deals that are 5 million or below, the wealthy entrepreneurial real estate operators, they do those deals. The rich doctor can fund it. The real estate operator can go get the money and get us SBA loan even up to 5 million. The 50 million plus deals or even just 20 million plus, that stuff's going to be done by the big institutions. The big banks fund those. It's big institutional money, insurance companies. They only mess time with big assets. But this middle market, this little sweet spot between there where the individual can't invest in it and the big institutions don't want to waste their time with it is their sweet spot where they go after. They have less demand for people that can execute on those types of deals. And so that is where they play and put their focus on and feel that like they have a strategic advantage. And I think as someone investing, you want to know, well, what is your strategy? What makes you unique? What are you bringing to the table? Josh McCallan, another one of the people, Accountable Equities, his company, they take distressed hospitality projects. So they'll go in and they'll find a dumpy resort that's dying and they'll find a way to revitalize it and bring it back. And he talked about all the unique things that they do to an asset. They bought like the oldest winery on the East Coast that was all run down and they turned that thing around and it's a huge resort now. They do weddings there and they've done all these things that bring in contracted revenue and it's very smart. They actually have an actual strategy to it about how they're going to deliver returns, increase value, how your money is going to go to work and come back hopefully larger. And so I think the next thing to look at is like, all right, what is the strategy someone has if I invest in? What is their take on it? And do I believe in that strategy? Do I think that hospitality would come back? Do I believe in that concept of the middle market having opportunity? And so, but this is the fun thing about alternative assets is you get to look at these things and make your judgment calls and invest where you believe there's the opportunity.
And I think another perspective, before we get into another asset class in alt, and maybe a third point is believe it or not, the more syndications you invest in this, if you're going to go in this area, say I'm going to do some multifamily, I'm going to do some hospitality, we're going to get into lending and other types of syndications, oil and gas, there's so much. The more you invest in, the less risk you have and the greater return you have. So when you find a syndication that you like, don't go all in. Find four. Because one, yeah, one's going to have struggles. Two, moderate returns. Number four, that we don't know which one could be the home run. And so all of a sudden you look at those averages, you're really diversifying your portfolio, and it's more exciting than stocks because these people are doing real projects you can
Yeah.
go kick the ground on, kick the tires, walk around, fly out there and check it out. And so in the most of these syndications, you're into them for 50 to 100 grand. And so you can deploy, many of you that have this old 401k with 4 or 500 grand sitting in it, you can be in 4 to 6 syndications and really diversify your program and begin again kicking in double digit returns from 10 to 15 to 20%.
Yeah. Now, staying on the real estate, I want to switch over here in a second, but just staying on the real estate topic. Let's say you want to be out and finding your own deals. You're like, I don't want to go invest with other people and just give them my money. I want to go do my own deals.
Okay,
Lots
that's
of our
fine
clients
too.
are already doing this. You can do that, of
Yeah.
course, and that's just we're doing that in our own real estate deals. Mark and I have commercial real estate, single family. This could be even you doing Airbnb or private money, doing private money lending. But one of the questions people always get is like, well, where do I start? How do I do that? How do I find good deals? And John Shekarchi was there. He's one of the board members that directed, very successful individual investor, invests in just his own deals and has built a significant portfolio doing that. And his tip for everyone was go find the best professionals in your local market. Real estate is a local investment strategy. Every market is different, different participants in it, different nuances to it that you can have an advantage on if you know your local market. But find the best professionals in that market, from real estate agents to mortgage loan officers to title companies, and be known as someone that can solve and fix deals that go bad, deals that need funding, deals that a bank rejects and that might need some private money, deals that have a zoning issue or a tenant problem. These problems are your opportunity as a real estate investor trying to find deals. And so if the professionals in your area know that, once you build up that reputation, you don't find deals. Deals find you. And that was his big point, and something that basically he has been a testament to of being, his deals just all come to him now.
Oh, I love it. Staying with real estate for a moment, and we went through. I was trying to create a list here at one point. Matt did have a list on his major takeaways, but let's give up on that. There's so many great things here. But on the real estate vein too, don't feel like you have to go the syndication route. That
Yeah.
works for a lot of people that want a passive role, but they want to exceed a 10% return. Very, very common. What do you think the big hedge funds are doing and all these family offices and the uber wealthy? This is why they're doing it. They make greater than 10%. It's doable. You just got to think outside the box. So anyway, I was going to say on the real estate projects, Matt and I are individual real estate owners. We own commercial properties, single family home rentals. I'm broaching short-term rentals right now, some Airbnb. I like the tax strategy that comes with that in the second half of the year. We've talked a lot about that on our Main Street podcast. Airbnbs in some markets are struggling. Others, they're just blowing up, doing wonderfully. You've got to know your local area, but it's okay. This is an old asset. Some of you are doing the midterm rentals, renting to hospitals for nurses that are traveling nurse projects. And there's a lot of midterm rentals, short-term rentals, long-term rentals are still alive and well. So be always on the lookout and forming these LLCs with your family members to pool money. You don't have to go stay away from the I word, investors. You don't have to look for investors. Look for partners in your local area with your family, your friends, and your kids, your parents, and you can really pool and do some fun things with real estate too.
Yeah, and Amy Majori talked about finding private money and how to find private money lenders or how to be one yourself if you want to loan to other people looking for money on deals. And that could be one of those perfect marriages of I've got deals, but I need money. And then there's other people who've got money but are looking for deals, and how there could be a win-win scenario there. Let's talk about just angel or venture investing in businesses. Yeah.
Now, Matt, would you give me latitude? Let me just say one more thing. I apologize, but before we go to the next asset class, some of you may be going, "Where do I find the deals?" We kind of addressed that, but how do I know what to do? And this is where education really starts to play a role. You cannot be a passive, you can do the passive thing, but just realize there is support. And why I thought of this, Matt, is when you brought up Amy. Amy has a coaching program. She's like, hey, you want to do private lending? We'll bring you along. We'll help source notes for you. We'll help teach you how to do notes. We'll teach you the due diligence involved. We're there for you. And so I just wanted to interject that a lot of these people that we're talking about, these all assets, they're not just saying, come do it with us. We'll teach you how to do it too. And so you really have to say, you know what am I going to do this fall? I got 6 months before Christmas. What are some education, what's some education I could do in some of these asset classes I'm interested in?
Yeah.
But anyway, thanks, Matt. Okay, so then the next
Yeah,
one.
yeah, and that was an excellent point. I think that's like, and that's the thing with alternative assets is you need to be educated. It's not like you're just like picking a Wall Street broker or looking at numbers, on your computer deciding, oh, I should invest in that. That's had the biggest returns. Like you need to be educated. You got to run the math and do the numbers on these things for yourself. Even if you're investing in a syndication or fund, you should be able to know that asset class that you're investing into and have a good understanding of what the numbers are. So lots of education out there. We're trying to bring these people, like Mark said, at our events. So, okay, let's hit business though. Angel and venture investing. So Lisa Walker, she's president of Tech Coast Angels, Orange County. Done a lot of angel investing, and she made a really important point there for those like investing in angel or venture deals. These are startups that are very new, that need funding to get off the ground, but they could become the next Uber. You never know, right? Even Amazon. I still remember Jeff Bezos telling the story about Amazon and him getting his first 10 investors. He went to 40 people. 30 of them turned him down. 10 threw in money. and they all made a grundle, of course. So, but these early investors called angel investing. And she talked about what they do and Tech Coast Angels. There's a lot of angel networks out there you can go look for. She gave a lot of great resources on how to find them in your area. But angel investing, she talked about how you need to at least invest in 10 companies because the majority of them are going to go to zero. Let's be face it, most startups don't end up panning out. 3 or 4 of them are going to maybe make 50%. Maybe they'll double your money. But 1 in the 10, what you're hoping for, will get a 10x, 100x return that makes up for the total wipeout and loss you had on the other deals that went bad. And so you have to have enough kind of shots out there, enough kind of like, fishing poles out, hoping for something to get hooked. And so, so that was an important lesson on angel investing and make sure people understand it. You can't just invest in 1 or 2 because you're likely to fail and lose entirely.
I loved it. And I want to just add another perspective on angel investing that I've heard over and over again, which is exciting to be a part of a project. And here's my takeaway, everybody. This is important. When it comes to angel investing or venture capital, you're kind of there at startups, different words for it. You're going into a startup scenario or a venture that's, they're just bootstrapping. You have to like the idea, but love the person behind it. You got to like the idea. That's cool. But you got to love the person driving it. Because it could be an okay idea with the person that's going to freaking make it happen. It could be an incredible idea, but they got the wrong person in the driver's seat. So like the idea, love the driver. And as you go out to look at those.
Love that. That was a great point. Dude, cut that right there. That was great. I love it. All right, let me talk. We had some advisors there. Michael Bradley and Brandon Scott from Bradley Wealth talked about investor portfolios. And these are investment advisors that really expose alternative assets to their clients. And they talked about that JP Morgan stat I gave earlier where those incorporating alternative assets are seeing higher returns, greater growth in their investment portfolio, and they're not seeing the volatility as much. And so not only are we seeing it from JP Morgan, admitting this themselves, they're seeing it themselves with their own clients, managing hundreds of millions of wealth for numerous clients. And so I think what you're seeing is even the smart financial advisors out there, there's a small section of Wall Street here, given that JP Morgan report, are starting to allocate more over to alternative assets. So that's just the next one on my list. Just want to know some of the financial advisors that were there and their thoughts too. Go ahead.
May I, on the financial advisor role, I had a financial advisor the other day, Matt, actually, I didn't tell you about it, kind of sent me an email. He wasn't terribly mad. He's a follower. He's a member of my Tax Pro network. And he was like, Mark, you guys don't need to poop on Wall Street as much as you do. And I was like, all right, fair enough. And it was a fair point. That notice how we said even 14% of people's assets around $1 million are in alt. And then even the uber wealthy, 80% are only in alt. Where's that other 10, 20, 30, 40%? It is in Wall Street. And there was my co-author of my book, Financial Freedom, Randy Lubke, and who's a licensed fiduciary financial planner, said, Mark, Wall Street is a great place to park your money until you find that right deal. And so it plays a role. Right now, the money market accounts are paying 4.5%. Some of you bemoaning these high interest rates, there's a double-edged sword here. You don't even have to go buy a CD to get 4.5%. It's just money market money. And so making sure your money's working for you in Wall Street, but it's deployable. And I think that's what these money managers had a great point about too, is that you don't completely disregard Wall Street. Use it as a landing board or a jumping off board or whatever you want to say to kind of get out there and still be involved.
Yeah, yeah, totally agree. I mean, we give Wall Street a lot of crap, but I'm still invested in Wall Street too, in addition to alternatives. And I do like that concept of it's a great holding ground. When you don't have anything to invest into, don't just sit in a bank account getting you zero. Now, maybe the banks are paying a little interest right now. It's a little unusual time where they're doing that. Typically, it's very paltry. But be invested in the market or in something until you find the better investment that can get you higher returns. Don't just take your chips off the table. All right. Next one was that I want to hit here was Jamison Manwaring. And this goes back to a real estate concept. He was a Goldman Sachs investment banker. Okay, he's an analyst, and so he was analyzing.
Oh, I thought you were talking about Jamison whiskey.
No, that's it.
Okay, sorry.
Back to this is not the alternative lifestyle podcast. It's alternative assets. Okay.
I was like, hold it.
Jameson whiskey. That's that helps your alternative lifestyle. All right, Jamison Manwaring. All right. So he's founder, CEO of Neighborhood Ventures. They're a real estate syndicator. But he talked about how he got to doing that. How did he get over to doing real estate and doing syndications and running funds in the real estate space versus he was literally on Wall Street at Goldman Sachs as an analyst, one of the most coveted jobs you can get out of college, learned a lot. But he basically said what he realized was every day everybody's trading and just trying to be the smarter person on the other end of the trade. And that he's like, there's all these people from MIT and Harvard. These are all the people in my office I got to compete with. And he's like, you know what? I started investing my own money and my own bonuses into real estate, and I loved it. And real estate was something where he felt like his creativity, unique assets, hard work could make a difference on an investment asset, and it could really prove a differentiator out there in terms of what you can make. And that's what gravitated him to leave Wall Street and go do real estate. And now he's out there, of course, doing bigger deals, syndicating, and they have a Reg A fund now, raising across the country. I thought that was just a really interesting lesson here as we're talking about Wall Street versus Main Street, so to speak, of someone that kind of left Wall Street, even in the coveted spot, to go do real estate because they thought there's better opportunity.
I love it. And this is an example that I've coined this phrase, and it hasn't taken off yet. But instead of angel investing, what Jameson is doing is devil investing, which I think I'm a huge advocate of, because devil investing is there's good real estate deals are always taking advantage of someone's problem, and you're seeing an opportunity where someone else doesn't see it. The angel investor, oh, I believe in you. I'm going to give you money and it's going to make so much. Devil investors are like, what's your problem? I can solve it. And I think you don't have to be.
Someone died, the bank's breathing down your neck.
No, you're not dealing with the smartest person on the other side of the deal. You're dealing with someone that's got a pain point, and you're going to take advantage of that. And that's the devil in you, and that's okay. You're going to make a great rate of return, and I think that's okay.
Well, let's maybe close out with this. This is one of the other ones that was really popular was Mark's section talking about not just building a legacy of wealth for your kids, but also maybe teaching them. Why don't you talk about that, Mark? Because that was a big takeaway for a lot of people. It actually got some high praise on my LinkedIn, So
thank you.
Why don't you explain that? What you're kind of the abbreviated version of the presentation.
The abbreviated version is everybody listening right here. you're trying to move the needle. You're trying to make some money. You'd like to live a better retirement. And at the end of the day, when it's quiet outside and you're looking at the stars or across the lawn or the beach or the mountains, you're leaving a legacy, right? You know you're going to die. And where's this money going to go? And a big problem in a lot of families and generational wealth is that the next generation's not ready for it. They don't know how to manage it. They don't know what to do. And people, you're doing all this to leave something for your family, but rather than just leaving them money, leave them the education and the experience with it. Get them involved right away. Every one of your kids, your nieces, your nephews, your grandchildren should have a Roth IRA. They should be your first investor and partner in these LLCs. So when you're doing a real estate dealers, and some syndications require, the accredited investor situation, but many of the projects you could be doing in the alternative assets could be done with your family. So now you're teaching your kids how you analyze deals. You're having regular board meetings, which are a great tax write-off. Some people are like, board meetings, those are only for big companies. No, your LLC should have a board of advisors. You should be having quarterly or annual meetings with your family, showing them what you're investing in, getting them involved in it. Kids want this. They're starving for this. I've had experiences with my kids where I start talking about money and engaging them in the investment process. That's all they want to do. They don't want to go to a movie. They don't want to go to a baseball game. They're like, show us more. We are starving for this. How many of you had your parents sit around the kitchen table and talk about their investments and their money? Very, very few. And then they wonder why their kids are not independent or going to blow the money when they inherit it. So my point in summary was build a legacy with your family, not for your family. And there's a very big difference there. When you're building that legacy together, they're going to pick up the ball and move it down the field when you're gone. If you're just building it for them, they're just going to go sell that football and go blow the money. Let's teach them how to continue the process.
Yeah, freaking love that.
I'm going to write that down. I'm going to write that down. That was good. I think I said it at the workshop, but I forgot it.
Yeah. Yeah, that was great. Well, remember, you can get to altassetsummit.com. If you miss it, recording's going to be up here in about a week or so. You can be able to buy the recording on the website now, though. And we'll be doing multiple ones of these every year. You can come and network with all the alternative investors. This is the last point I want to make is, as you're making these investments, whether it's in real estate or private companies or small businesses, your regular funds, your IRA funds or retirement account, getting your kids involved, whatever it may be, one of the best things is just to go meet and network with other people that are doing the same thing and see what they're doing, learn from them, talk to them. It's just nice being with like-minded individuals that are out there trying to do the same thing, build their wealth and their dream, find these alternative assets and these opportunities. And so make sure you're getting engaged and finding those people. They're at the Alt Asset Summit. They're Mark's upcoming Tax and Legal 360 conference.
Yeah, taxandlegal360.com. The end of July, it's going to be in Salt Lake. 3 days, 45 sessions, 36 topics, 17 speakers, and people, it's affordable. General ticket's like $500. There's a premium for $750, and that includes lunches and network opportunities for 3 days. And very, very affordable. We have a discount for your significant other that just wants to come to the networking pieces. Please come. It's in the Grand America in Salt Lake. It will sell out. The VIP's already sold out. There'll be a virtual aspect, but the networking is so exciting. You get there, you're talking at the cocktail parties and the receptions. We're going to have music 2 nights. It's going to be a really good time. And then Raleigh, North Carolina, coming up in October. We're going to be there for the Directed IRA Summit. Come to the East Coast in the fall. So beautiful. It's going to be just amazing.
And that's going to be sdirasummit.com. That stuff's already up too, ready. You can get your tickets now. So we're out there trying to spread this information. Make sure you're signed up for our newsletters. You can get that at mattsorensen.com, markjkohler.com, directedira.com, kkslawyers.com, wherever we're at. Sign up for our newsletter so you can get updates on what we're doing, educational events we're doing, videos going out, podcast episodes, all of our events. We want to just continue to get you great information. And we'll be back next week, of course, with another amazing episode of the Directed IRA podcast. Until then, stay calm, self-directed.